Excellent. Well, great to see everybody here today at Fintech South. Very, very excited to be with you all today. Well, my goal today is very, very, very simple. So I want to share with you all some of the latest global trends that we are seeing in the broader digital space. And my goals today for all of you who are at home, be able to empower you with these trends and knowledge and information, and then let you make your own decision on what you think the impact the broader crypto industry is going to have on the broader financial services industry. Are you guys ready? We're going to have some fun. Let's kick it off today then with really our presentation on latest global crypto trends. But before I start, I always give a big, big warning. Anybody who tells you they're a crypto expert, you have to run away. You know, I spent 24/7 of my time in this space, and I can tell you the crypto space is a bit like dog years. A week in this space is like 7 weeks in a normal world. Things move tremendously quickly. And this is why today I'm just going to focus on 5 trends. 5, nothing less, nothing more, on these 5 developments that I think you need to know to be aware of the latest developments in the space. Let's kick it off. The first one is really what's happening on the broader institutionalization of the crypto industry. Again, when you look back a couple of years ago, the crypto industry was run by a lot of startups, by 2 guys in a t-shirt talking about Bitcoin. But really what you're seeing right now is the ecosystem is becoming increasingly institutionalized. For example, many areas like crypto custody, for example. We started with tools in 2018 that was self-custody. Last year, we started seeing the first regulated offerings. And now you're seeing a lot of traditional financial institutions enter the space. But it's not only for custody, even crypto derivatives, where you saw a lot of the unregulated exchanges coming up with then cash settled or physical settled derivative products. And now you're seeing an increase of offerings of regulated such offerings in the market. And even the players, a lot of the players in the crypto industry as well are becoming institutionalized as well. A lot of them getting Big 4 audits, getting actually proper assurance reports. A lot of doing a lot of the stuff that the traditional financial institutions that you know and they're used to deal with are actually involved in. Even on the regulatory front, you know, today there's a lot of global initiatives going on to try to actually ensure that there's actually we're able to track and keep the bad guys and the bad apples away from this industry. AML is a great example from this. You know, where again, there's been a lot of clarity over the last 2 years how the money laundering rules apply to the crypto industry. It's not because people are dealing crypto that they're completely outside the ecosystem of the regulatory reach. But also, we are seeing an increasing number of institutional players enter the market. You know, over the last couple of months, really what we're seeing is that a lot of the big developments going on in the crypto ecosystem are not being driven by small startups, but a lot by the large financial institutions and regulated players who are really increasingly entering the space. And there's a number of catalysts for this. There's a number of reasons why a lot of these firms are coming in. You know, some of them is increased regulatory clarity. But a lot of them, it's actually clients are asking from them. You know, if you're a private banker and your client is asking you about Bitcoin over and over, at one point, it's probably a good idea to have a Bitcoin offering. And the same thing from other external pressures as well, like Libra, which we'll talk about in a couple of minutes as well, really putting a lot of pressure on it. And we're really seeing different organizations take different approaches. Some firms have been investing in crypto companies. Others have been partnering. A great example here being the Nomura and Ledger joint venture that's come up with a product called Community, which is crypto custody for institutional players. Others are doing in-house initiatives, whereas others are launching separate standalone entities made to cater for the crypto industry, like a bit like what Fidelity is doing right now. But another big development going on that is driving a lot of these institutional players coming in is regulatory clarity, but also enforcement. Today, if you look globally, numerous jurisdictions right now either have had or are developing regulations specifically for the crypto industry. Again, the crypto industry was probably the only vertical of the financial services industry that was actively lobbying for more regulations. Very different from a lot of traditional financial firms. And what's really interesting today, if you look at it, there's only 5% of regulators who do not have somebody working on crypto internally. This is according to Cambridge University. So again, a great example of the regulators actually coming and providing clarity. One area we need more clarity is tax clarity. Actually, at PwC, we just published a report last week. You can find it on my LinkedIn page or online that actually gives data on when it comes to the regulators and the tax authorities providing tax clarity. So a lot of developments going on in this space, a lot of work to be done, but for the industry to be increasingly institutionalized, we need tax clarity. But also there's crypto enforcement. Over the last couple of months, we've seen regulators be increasingly more active in the space. Even last week, we saw them actually go after one of the large crypto derivatives exchanges. So a lot of regulators are continuing being active. And again, this is a trend we should expect them to see over the next couple of months. Another big trend that everybody should be aware is what we call the rise of stablecoins. So what is a stablecoin? Traditionally, if you have, let's say, one Bitcoin, a Bitcoin, obviously the price is determined by offer and demand. It's really basically what people are happy to pay for it, around the world. But one interesting thing is one of the kind of digital assets that is gaining a lot of popularity are stablecoins, which is digital asset that is backed one-to-one by US dollars or other fiat currencies. And there's a number of them. Some of them are regulated, where they're actually regulated by either the New York Department of Financial Services or other regulators in the US and abroad. And these actually are a meaningful part and play a big role in the stablecoin ecosystem. Others, like Tether, are not regulated. And some others are actually completely decentralized, where you have literally smart contracts and algorithms that actually stabilize the price. But all these to say, all these models, the goal is that we are seeing a rise of these stable coins in the market. Today, there's billions of dollars of such stable coins available in the market that people are using every day. But you may say, why are people using this? What's the purpose? Well, for example, today, if I send you a Bitcoin, well, first, you'll be very happy. But the problem is we don't know how much this Bitcoin will be worth a week, a day, a month, or a year from now. Whereas if I'm able to send you a stable coin that is worth $1 today, will be worth $1 tomorrow and next month and next year, we can actually conduct a lot of trade and other day-to-day activities. Again, if you're just in Georgia, you're just in the US, and you're sending money within the country, you don't need this. There's a million other ways to send payments, whether your banking app, your Venmo, and others. However, as many of you know, you start sending money on a cross-border level, that's where it becomes complicated. Today, the average fee of cross-border fees is around 7%, and that's the global average. And this is one thing that stable coins can solve. I can send $1 from Hong Kong, where I am right now, to, let's say, somebody in New York. It works 24/7, almost instantaneously, and for almost no fees, which is very different than what a lot of banks are doing. But also encouraged by this, a lot of banks got into it as well. And over the last couple of months, we saw a lot of banks discuss potentially launching their own digital currency. Again, the idea is not crazy. If you're able to have the balances of your clients, you're able to issue them in a digital currency, and they're able to use the stablecoin digital currency between them, it's great. You kind of become a bit of an ecosystem, a bit like the big Chinese tech platforms. So a lot of interesting developments going on from that perspective. Another big development that you need to keep an eye on is what we call decentralized finance. Often we use the term DeFi for short. What is DeFi? Really, DeFi is the delivery of financial services without any centralized financial intermediaries. Again, and how are we able to do this? By leveraging blockchain technology. And this is an area that is really a bit, out there, really left field, really until a couple months ago. And over the summer, DeFi really took off. You're seeing now a lot of people work on it, a lot of people follow the space, and there's a lot of activity in this space. But again, still quite tiny. If you look at it, again, the total value locked in DeFi, which is kind of the amount of the money that is involved in DeFi, is around $10 billion, give and take. Again, when you compare this to the traditional financial services industry, it's tiny. But why does this matter? Why does DeFi even matter? Well, a couple of reasons. First, it's open to anyone. Today, a bank, your bank, needs to decide whether it wants to do business with you. If your bank doesn't like you, well, tough luck. You're not going to be able to do business with them. So this is the good thing with DeFi. It's open to literally anyone. And this is why many believe it can encourage financial inclusion. Second, it's really permissionless, and because literally anybody, the code is public, and anybody can come and build solutions on a DeFi offering. Today, most banks guard their offerings and their technology stack very, very confidentially. It's very private. And actually many regulators around the world have been trying to encourage what we call open banking, open APIs, to allow people to, if the customer allows it, to be able to access a lot of their data and be able to transact. The beauty with DeFi is all the technology, the code, everything is open, allows people to build on it. But probably what's the most exciting with DeFi is what we call the composability, what I like to refer to as financial Legos. What is composability? Is that any DeFi application that you have around the world, you can leverage it and use it on top of each other. It's literally like Legos. Imagine you have a pile of Legos. You can use those blocks in the way you want it, using your creativity, and build whatever you think will be the most helpful. And that's what's quite remarkable. Today, imagine if you can build a fintech app where you literally could take any fintech app you saw out there, do whatever you want, and take bits of parts of each one of them and put it together, and that is immediately available. That is what composability means, and that's what a lot of people are very excited about DeFi, because it really opens up a whole world of opportunities. And it's smart contract based. It's permissionless. It's there. There's no centralized authority. Really, everything is decided by the code. So if the conditions are not there, the transaction will simply not go through. So a lot of interesting approaches going on there. It's really what's really exciting. It's actually taking a first principles approach to financial services, really rethinking how we can deliver financial services based on really what often financial services are meant to deliver. And there's a lot of other issues. There's a lot of actually opportunities with it. The one thing I think it's important to understand is that we are very, very early stage so far, and when it comes to DeFi, but again, it allows us to actually experiment with some of these models that we have today. Again, we're at the very, very early days of DeFi. There's a lot still needs to be done, but at least what the last couple of months have shown us is that actually DeFi could actually work. Some of the tests, what was before just a theoretical concept, what we were able to test only at a small scale, now we're able to see that we're actually able to leverage this and actually trade billions of dollars every day. Really, this month has been very interesting for a lot of the decentralized crypto exchanges. The volumes are actually higher than some of the large centralized exchanges. Also, when you look at the different offerings that are being offered from some DeFi products, from lending to having some kind of robo-advisor offerings to even insurance, all the traditional services that you are used to getting from a traditional financial services industry, you're able to get them in DeFi. So very, very exciting space to come in. You need, again, we're at the very early stage, but at least you need to be aware of the basics of DeFi. And the big last trend that I'll finish off with is really central bank digital currencies. Again, what is central bank digital currency? It's a digital currency that is issued by the central bank. What does this mean? Again, if you're a central banker and you love Bitcoin, you're crazy. It's a bit like a taxi driver being excited to see Uber come in the market. What's a CBDC? It's actually a central bank that is issued by the central bank. And this has been very interesting because in the early days, central banks were very reluctant to CBDCs. But really, things have changed over the last year and a half. Today, 80% of central banks are, according to the Bank for International Settlements, doing some kind of research or experimentation or pilots on central bank digital currencies. What makes central bank digital currencies interesting? Again, because they're digital currencies issued by the central bank, they become part of the monetary base. And there's a lot of advantages central banks have. For example, they're able to trace on the monetary policy. If people are using a CBDC in their everyday activities, they're able to see actually what is the impact of one of their policies on everyday people. Second, again, a big advantage we have with CBDCs, it reduces the risk of money laundering. Today, again, the best way you have to launder money is using good old cash. Again, nobody knows where it comes from, but nobody knows where it's going. Whereas actually one thing with CBDCs is that for the first time in a very long time, it actually gives us a fighting chance against money laundering. And that's super exciting. And I think it's something that's worth exploring from that perspective. But initially, the central banks were very reluctant. The Bank for International Settlements, for example, the BIS, the club of central banks, said actually that, you know what, cryptocurrencies and blockchain technology, they're a poor substitute for the solid institutional backing of money. Very negative. Same thing with the ECB. Again, came in and said, hey, the central bank digital currency and crypto assets can be dangerous because if everybody starts using them, people can take their money away from banks and hold them in digital wallets, and that may accelerate the run on the banks in the event of a financial crisis. So again, very interesting development going on from that perspective. Because remember, if tomorrow morning you don't trust your banks anymore, You can go to an ATM, try to withdraw your money, but there's a physical limit to how much you can withdraw and how you can securely store it. However, with a CBDC, you can move it into a digital wallet very quickly, and this actually, in the time of crisis, may accelerate the run of the banks. But all of these conversations were very good until Libra happened. In June 2019, Facebook announced Libra and Calibra, which was how their wallet was called at the time, really to try to tackle this big problem. And really, the problem to try to tackle was actually cross-border payments, the problem that I mentioned before. And when Libra came, it really catalyzed this conversation. A lot of people were not happy, including the president, who said that we have really one real currency in the US, and it's stronger than ever, and it's called the US dollar. So a lot of actually pushback on Libra at the time. But then also a lot of politicians were not very happy. Many of them sent letters to the CEOs of companies who were involved in Libra and said, hey, if you get involved in Libra activity, you're gonna get a high level of scrutiny, not only on your Libra activities, but on all your entire business. So a lot of actually pressure there, and actually a lot of concerns, rightly so, by a lot of policymakers who got worried about what could be the impact of something like Libra on the broader economy. And especially this is why the big conversation started on global stablecoins. Because again, if everybody is using stablecoins like Libra or using actually cryptocurrencies to make such transfers around the world, this could create issues on monetary sovereignty and challenges for central banks. Because often in many cases, you're not able to control in the same way that you're able to do with actually having either paper banknotes or with the reserve accounts that the member banks have with the central bank. So a lot of discussions around this, a lot of concerns that were raised by the FSB and others, and really there was even worries about the bank funding, actually how banks can be affected by this because of this conversation. So a lot of discussions around this topic, and it's important to understand there's different types of CBDCs in the market. There's wholesale CBDC, which is between central banks and the banks, and there's retail CBDC, which is a central bank digital currency that you as a public interact with. This is the right side. That's the right side, is the one where we're seeing a lot of activity right now. It's really how people can interact with CBDCs and how they can interact with it. There's been different models proposed there. One of them is a two-tier model, which is a Swedish proposal, where the CBDC is issued by the central bank, but distributed by traditional banks. Others, actually, it's some kind of a narrow banking model that was discussed many years ago in the US, where it's actually a stable coin issued by providers, but that is backed with reserves at the central bank. Others is in a model we call the platform model, where the central bank sets up a platform that other providers plug in, and that can enable the distribution of central bank digital currency. So there's a lot of discussions around there. Some models are what we call a token-based model, which is a bit like cash, which you're able to see and hold offline, whereas others are more account-based, like your bank account, for example, where there's actually a centralized provider. So a lot of discussions around this, and this was again catalyzed this summer again when Libra 2.0 was announced, where they dropped the idea of having a global currency and moved to actually a stable coin model. A lot of discussions going on in there as well about how Libra is going to have an impact. But the big elephant in the room, what country you need to watch is, of course, China. China obviously has made a focus now. Xi Jinping has spoken about blockchain many times, crypto, and it's become a big priority. Bitcoin mining was removed from the prohibited list. And actually, China has announced officially that they're conducting a live pilot very soon on the usage of digital currency, of which what they call the DCEP, digital currency electronic payment within the country. Again, this is going to be initially privately owned. The goal is to replace paper money. China is de facto cashless anyways, but this is definitely, China is way ahead of any other country on this topic when it comes to right now at the global level. So really, if there's one country you need to watch, is China when it comes to DCP. It's obviously becomes very political these days, but I think you need to look at it. China has been researching this topic since 2014. So a lot of work has been done on this side. That's all the time I have today, guys. But one thing I'll say again, it's a big warning. Again, remember, anybody tells you they're an expert in this field, you have to run away. The space is moving extremely fast. That's all the time I have for today. Again, thank you very much. For anybody who wants to follow my work and follow a lot of the work I do in this space, you can follow me on LinkedIn. Have a weekly 60 seconds video where I share the big developments that you need to know about. And also you can follow me on Twitter as well, where I post a lot of these developments as well in the space. Guys, thank you very much. It was a pleasure being with you all today. And thank you, and see you guys hopefully next year in person. Thank you very much, everybody.